Well, hi everyone, Sean Humphreys here. Welcome to All Things Retirement. In this installment, we're going to talk about tax-free savings accounts and specifically why we shouldn't call them tax-free savings accounts. You'll enjoy this particular video. Now, if you're new to our channel, make sure you hit the subscribe button. We post content all the time. If you're in the runway phase of retirement income planning, you're 5 to 10 years away and you want to make sure you have a great strategy in place, we've got content for you. Maybe you're in the transition phase, you're just about to retire, you know there's a lot of details and you want to get it right. You don't want any regrets. And maybe you're already retired and you just want to stay happily retired. So hit the subscribe button. We have content not just on the financial aspects of retirement, but the relational, the physical, the recreational, all the different aspects that intersect to create a wonderful retirement journey. Now, tax-free savings accounts for the last number of years have been a great vehicle for Canadians to save money. 2009 was when they were first introduced, and Canadians have firmly embraced this vehicle as a way of accumulating capital. But here's the problem. Words can be very powerful and they can direct behavior. So when I say to you, we've got a new account, it's called a tax-free savings account, what impact do you think that will have on people's behavior when they invest money? Well, you're right. When you see the word savings, all of a sudden people make the assumption that that's how you invest money within the tax-free savings account. Now that has changed over the years, but when they were first introduced, that was kind of the default position. There were millions and millions of dollars sitting in savings accounts and GICs because that's what people thought that they could do. That was really the only option. They were savings accounts. But of course, tax-free savings accounts are much more than that. And if you are dealing with a financial institution that provides you full brokerage capabilities, you should be able to purchase not just savings vehicles and term deposits and GICs, but you should be able to hold mutual funds or exchange-traded funds or stocks or bonds in your portfolio. And what will drive your investment decision will first be your goals. What are you trying to accomplish? For some of you, it might be short-term goals for vacations or buying a new car or renovation. For others of you, maybe you'll use some of the money in your tax-free savings account to supplement educational costs for your children. And for others, it might be retirement planning. But whatever your goals are, you want to make sure you match your investment strategy for those goals. We won't talk about that in this video, but the main point is tax-free savings accounts are a much more versatile and flexible investment vehicle than just or account than just sticking the money in savings. Okay, what I'm illustrating for you right now is just comparing two different investment strategies for our tax-free savings account. So I just talked about why putting money just in savings may not be the right strategy for you. Now, in saying that, if you're saving for short-term goals, it could be a vacation coming up, a new vehicle you're purchasing, then putting the money in savings where there's less market volatility would likely be appropriate for you. If you're saving for educational costs, maybe you put money in other vehicles that might give you a little more growth if that cost is 5 or 6 or 10 years down the road. And certainly if you're using your tax-free savings account as a way of accumulating capital for retirement, you want to make sure that you put money in investment vehicles that give you better than a 2% return. Now 2% is one of the illustrations we used, and then 4% is the other illustration. We encourage our clients to strive to get returns at least 2 percentage points above the risk-free rate. So right now, if the risk-free rate is 2%, that's about where it is today, then we want to make sure we're trying to get at least 4%. And that helps you cope with inflation and tax costs ultimately on investments. Now with the TFSA, we don't have to worry about tax costs, which is one of the wonderful things about TFSAs. So what we did is we have two illustrations over here, and you can see that we're making a regular deposit of $6,000 to each of the accounts. We're going investing at age 25 in this example, and we're going to stop investing at age 65. So we've got 40 years of cap accumulation. Now in the option where we're assuming a 2% savings growth rate, we're forecasting that the value of the account will be basically $369,660 at 2%. That's investment option 1. If we get 4% over that time period, for forecasting the value would be $570,153 for a difference of $200,493, a very significant difference. So again, just to summarize, if your investment objectives are going out the next 5, 10, 15, 20 years, You want to use a strategy that tries to boost those returns for you. If your goals for your TFSA are shorter term, so you're looking at saving money for a vacation, or maybe paying down some debt at some point, or a down payment on a house, well, then you need to be more conservative with your strategy. Time is the investor's best friend. So if you're trying to deal with market volatility and trying to get better returns, the longer you're investing, the more you smooth out the variation of return on your portfolio. Well, it's my hope that I've gotten you to think a little bit differently about your tax-free savings account. So again, what are the action steps that come out of this particular video? Number one, get really clear on your investment objectives. What are you trying to save for when you put money into your tax-free savings account? And it may not be just all one thing. It may not just be for long-term savings. It might be for short-term savings, medium-term savings, and long-term savings. So your goals will define then your investment strategy. So number two, make sure you're dealing with a financial institution or advisor that gives you the full suite of investment options. So it could be savings accounts, it could be T-bills, government bonds, stocks, exchange-traded funds, mutual fund options as an example. So you want that maximum flexibility. You always want to be mindful of the opportunity cost. So when you talk about tax-free savings accounts, we're really talking about tax-free investment accounts driven by your goals and objectives for what you want that capital to do for you. Well, it's my hope that you found this particular video helpful. If you did, make sure you click like and be sure to share it with friends and family if you think they could get value out of this particular content. As well, we've got a link to a video that is related to this particular topic. Make sure that you hit the subscribe button to get the most recent content that we're uploading on a regular basis. And in the show notes, you'll be able to get to our website where we have a lot of great resources as well. All the best in your retirement journey.